All right, welcome. We're going to go ahead and get started. Thank you all for joining me today. My name is Charla Roth. I'm going to be presenting for the next 50 minutes or so on overhead audits and overhead rates, walking you through all the navigation on understanding your own FAR overhead rate and what's the process of going through an audit if you've never gone through one. So there's an option to ask questions. If you have questions, I'll try to address them as we go through. If we don't get through them and we run out of time, I'll certainly email everyone back with a response. So here we go. All right, so as I said, my name is Charla Roth. I am a partner here at Danable and McKee. We are a firm out of Central New York, Syracuse, New York. We do have offices in Binghamton, New York, as well as Albany, New York, Tampa, Florida, our most recent, and as well as Auburn, New York. But we do business throughout the country, working with architecture firms in California, all the way down to Florida. So much experience working with all of the firms across the country. We have quite a wide representation today. Appreciate that. So hopefully we can help you understand your FAR overhead rate once we're done through this 50-minute presentation. So Danable McKee, I mentioned our different offices that we specialize out of. We do have specialties in both audit, which I am an audit partner. We have tax professionals as well as accounting services, and we do perform valuation services for various clients such as yourself. We have actually a very specialized sister firm that performs all of those consulting services for firms looking through to go through ownership transition or developing strategies for buy-sell agreements. So we can help you with all of those needs. We actually have some ownership transition seminar series that we offer in both full day and half day webinars. We're going to be sending out this presentation to all of you after, so no need to write these dates down. If it's something you're interested in, certainly there's the half day or the full day option if you're ready to dive right into some ownership transition. So today, those just joining in, we are going to walk you through understanding your FAR overhead rate, and if you are going to require an audit, what that looks like. It's a very specialized process, and not every CPA firm can do these audits because it is so specialized. So we're going to talk to you a little bit about what that comprises of and your next steps. So over the last couple of years, probably the last 10 years, we have seen a growing need for firms across the country needing FAR overhead audits. More and more businesses really starting to get into the work with the DOTs across the country, other different authorities, and all of them are really starting to hone in on needing what is called a FAR audit. And what that stands for is Federal Acquisition Regulation. So all of that is just an acronym for FAR. You're going to hear FAR all over the place. So when the demand for these FAR overhead audits picked up, they came together, the New York State DOTs, and formed an audit committee under AASHTO to perform this audit guide that all of us are supposed to be performing our audits under. So trying to create some standardization. So the FAR audit is all done under what you've probably heard of, FAR Part 31. And that's really the cost principles surrounding federal acquisition regulation. So the whole FAR is 1,900 pages. You're never going to read that entire document, but the specifics within FAR that we're going to be dealing with your overhead rates, that is called FAR Part 31, and that's only 50 pages. So it's a good read. If you're looking, you can't fall asleep at night. It'll put you right to sleep. But it's really, in essence, it is a good read. FAR Part 31, that's hard to say. Some other overhead guidance that you can look at is if you have defense contracts, you're going to hear this DCAA, Defense Contract Audit Agencies. I'm sure you've heard of that. Now, they have their own contract audit manual that is quite extensive, but we're very familiar with that, and they have very specifics that they want covered under their audits. So they also have what is called FAR Cost Principles Guide that's out there as a resource as well. So I talked about this word AASHTO. What does it mean? So AASHTO is the American Association of State Highway and Transportation Officials. So way back in 2021, they formed this committee, as I mentioned, this audit subcommittee, to try to bring all of the departments of transportations together to have this universal audit that is performed so that there weren't differences state to state. So if I did work with the New York State DOT, it's the same as if you worked for the Arizona DOT. So the audit would comply with both states. So that's really what this AASHTO guide is doing. It's a guide for both engineering firms and ourselves as auditors to understand what's required under a FAR overhead audit. So as I said, this committee was formed. They have since revised this audit guide, which is great, based upon a lot of suggestions from engineering firms, from CPAs. So the guide has been superseded a few times. And most recently, the 2024 edition came out. Major changes really consisted of things that us as auditors need to focus on: risk assessment, sampling, all things that we have to focus on. So states, as part of this AASHTO, they all agreed to give up their state-specific rules. Many states still have their little nuances that they like to focus on, but for the most part, they're going to defer back to this AASHTO audit guide. And the whole point of this really was to increase the reliance on CPA's FAR audits so that they weren't having to go and re-audit each firm's audit. So previously, there were multiple states requiring multiple different specifications. Now you'll see that it's all being recognized and accepted by all the states. Small firms may be exempt from what we call this FAR audit. Usually there's a net revenue or gross revenue figure that the DOTs or other state agencies require, or federal agencies. Here in New York, the guidance is $1 million in gross revenue. Obviously, it's very easy these days to get to 1 million gross revenue. They haven't changed that number as time has gone by. So if you are doing work with the DOT here in New York, you would be qualified for, you would have to have a FAR audit under these guidelines. So there are some pretty unique and complex items with FAR that we're going to go through, but as an engineering firm, you are really required to understand everything and all the nuances within FAR. So we're doing these courses in order to educate your firm a little bit better, but also we partner with firms to give training to firms to help understand what FAR is and how their firm can be in compliant. So you have all been computing FAR overhead rates for a long time now, but it seems as though every year everything gets a little bit more complex. So we're going to walk you through what some of those confusing items might be throughout this presentation. So, without proper guidance from CPA firms such as ourselves, you could be at a disadvantage for negotiating certain contracts, leaving money on the table for dealing with any government customers. Obviously, it's very critical to understand FAR and understanding your FAR overhead statement. And it's just as equally important that you're utilizing the FAR overhead statement that's actually in compliance with FAR, which we review a lot of CPA's work, and some firms really just do not understand FAR and all of its nuances. So when firms are just getting started out with doing business with a government agency, they may get stuck with this estimated rate. And obviously, it is a much lower rate than your actual rate may be. So you want to be careful on that to not get put into a contract and locked in at that rate. Reach out to firms such as ours. We can help you work out that FAR overhead rate. Maybe you don't need a FAR audit to start, but just getting your books and records in compliance so that you're able to complete a overhead rate and look at what FAR disallowances you may have as a result of some of the costs that you've incurred. Often the first phone call I get is, oh, Charla, I've really got to maximize my overhead rate. How can you make me maximize my overhead rate? We hear that so much, but we have to also understand, does that really make sense? It's very critical that you are obviously calculating your FAR overhead rate using your correct direct labor base. That's always a big issue. Your first couple years getting into FAR, making sure that that direct labor base is accurate. You also need to make sure that all the allowable overhead is being allowed and that you're not disallowing any items that you shouldn't be. In talking with professionals as ourselves, we're going to help you get there to make sure that you're maximizing your overhead rate in that sense. On cost plus jobs, you're only going to be reimbursed for your overhead. You're not profiting from that. So in some instances, you may have contracts where they cap your overhead rate. So really maximizing your overhead rate is not the goal. It's really making sure you're using the appropriate overhead rate. And then remember, if your firm has both cost plus and lump sum contracts, really having any additional overhead is going to reduce your firm's profitability. So when you say, I want to maximize my overhead rate, you really need to understand what it is you're trying to get at. Our goal, obviously, is always to control our firm's overhead, and we're not going to incur unnecessary expenses just to increase that overhead rate. Again, it's about thinking about minimizing the disallowances and making sure you're maximizing the overhead rate of the costs you've already incurred. Another important consideration is how your FAR overhead rate compares to others in the industry. So while government contracts are awarded based solely on qualifications, there could be times where you are at a higher FAR overhead rate than other firms in your area that may price you out of the job. So looking at that as well, and we can help you with that. We have a lot of resources to help compare overhead rates across the country to make sure that you're in line. Here's one resource. We use PSMJ. I'm sure many of you are familiar with this, and hopefully you participate in the survey. Overall, this is an overhead rate throughout the country. So obviously it's anywhere from New York all the way to California. So overall, you'll see a median rate of 187%. And this is combining large firms and small firms. So you can see, we do have it by staff size. We do have it by, 1 to 20, all the way up to large firms over 750. So not a huge variance, but if you, within the tables within PSMJ, it also breaks down the regions in the states. So all of that is helpful information that we can help work with you on. So when we hear from an engineering firm that's just looking to get their feet wet and finding out what their overhead rate is, and they are going to need a FAR audit at some point, the first thing we do is look at your internal financial statements. That's really the first step, is formatting your trial balance and your internal financial statements to really understand that your costs are in the right buckets. So it's very important that we understand, do this to understand job profitability, and also preparing an effective internal financial statement is good for all sorts of internal analysis, profitability analysis, and it helps you make sure that you're comparing to industry standards properly. So one thing that we see most often is firms not segregating their direct costs from their indirect costs. So your direct labor, your direct expenses, your reimbursables, all of those need to be broken out from your overhead. And that's the first step to this hurdle of getting your statements in accordance with FAR. So we'll work with you on that. This also quickly allows for you internally to determine your FAR overhead rate at an instance. So at month end, you can determine what your overhead rate is versus waiting till year end when the auditors come in and calculate it. So you should be understanding what your overhead rate is all year long. So this is what some of your income statements might look like right now. It's a very general format. You've got your revenue, your cost of sales, and then all of your selling general administrative expenses below. This is for what you would assume under a manufacturer or just a general company. AE firms are very, very specific. You guys have direct expenses that you really need to break out to see what your gross margin is on jobs, as well as what your actual overhead is, your overhead pool. So this is really what your financial statement should be looking like. And if your statement does not look like this right now, we can work with you on working on your chart of accounts to help develop a statement that looks like this. So you should be starting off with gross revenue and then backing off any reimbursable, any expenses, coming down to a net revenue. That's an important number that you need to understand, the base number, your net revenue. And then we deduct your direct labor, your labor spent on jobs, and your direct expenses, coming down to your contribution margin, really your profit on jobs, okay? And then that's where we come in and calculate your overhead. You'll have your indirect labor. That's all your labor from administrative items, trainings, development, marketing time. That's all in overhead. And then obviously you have your payroll taxes, your fringe, depreciation, and any other operating activities. So really, this is where how your presentation of your statement should be. And if this is not where you're at to date, we should really look at reevaluating that. Many of my clients, my engineering firms and architecture firms, break out discretionary items such as your bonuses and your profit sharing contributions, because that's really after your normal recurring expenses. So you want to know what your profit is before discretionary items. So breaking those out to down below is very helpful for management. So the chart of accounts should also be formatted to allow quick and efficient determination of your firm's overhead rate. So we've talked about that a lot. So we really need to make sure that you at any point in time can instantly calculate your overhead rate. And you may not be able to calculate a FAR overhead rate, but at least you know what your overhead rate is to start before we start analyzing what some of those FAR disallowances may be. So we've been talking about this FAR overhead rate. So this is what a statement would look like. If you were to hire a CPA firm such as ourselves, this is what a statement of indirect expenses, direct labor, and overhead rates per direct labor dollar incurred looks like. So there's no revenue figures in here. There's no direct expenses in here other than direct labor. It is really all just your overhead. So you've got your indirect salaries, your payroll taxes, your rent, all of those overhead costs, utilities, repairs and maintenance. And then you have this direct labor factor that is direct time spent on jobs. So you're going to divide the direct labor by the overhead in order to calculate your overhead rate. And then you'll see this middle column here. This is called the FAR adjustments. So under FAR, there's a lot of items that the government says, no, you may incur this overhead expense, but we're not going to reimburse you for things like that. We're going to go through some of those nuances of what is considered a FAR disallowance and how you can easily identify them. And you don't need to be a CPA such as yourselves to understand some of the basic FAR disallowances. So determining FAR disallowances under FAR. FAR states that as management, as yourselves, you are really supposed to understand what these disallowances are, and you're supposed to identify them. And you're supposed to be able to tell us as the CPAs what those FAR disallowances are. Now, some FAR gets pretty specific, and there's times where you may need our help is to help management identify some of those nuances, but some of the basic ones are things that you should be able to identify. FAR is very specific in that it provides that the cost is an allowable charge to the government only if the cost is reasonable. So it's their determination if it's reasonable. If it's allocable to a government contract, that it's in compliance with generally accepted accounting principles. So GAAP, you may have heard the word GAAP. And that they must be compliant with the terms of the contract and not be prohibited under FAR 31. So what are some of these common disallowances? So the government says, we are not going to pay for you to go out and advertise your business. Now, this is a lot of marketing costs, advertising costs, attending trade shows, like hosting a booth at a trade show. Sometimes even things such as purchasing polos with your logo on them is considered advertising. Business cards, that's considered advertising. So all of these costs are disallowed under FAR. They're not going to pay you to advertise your business. Now, bid and proposal type costs, you might consider that as part of marketing. Now, those are allowable, and we'll talk about that a little bit further. Bad debts. So if you have write-offs from clients that did not pay, that's not considered an overhead expense. They're going to have you disallow that. If you are a firm that likes to contribute to community organizations, that is not allowable under FAR. They're not going to allow you to make donations. You can make the donations. They're just not going to reimburse you for that under your overhead rate. Makes sense. Personal use of company vehicles. So company vehicles, all of you probably have company vehicles. You really should be tracking those by utilizing mileage logs, because personal use of company vehicles has to be tracked. And that includes commuter time. So commuter time from your home to work is considered personal. It is not business use. So the only mileage or costs of the vehicles that are allowable is your percentage usage for business. Okay. That's a very hard concept and also a very complex procedure for people to go through if you're a small firm. So it's something that we have worked with many firms on developing mileage tracking systems to help ensure that you're keeping track of this for the usage of FAR. Fines and penalties, if you have any penalties from the IRS, those are unallowable. If you have any fines or late fees, those are unallowable as well. Lobbying and political activities, so part of your ACEC dues, there is a piece that is considered political and lobbying costs, so you would have to disallow a portion of those. If you donate to a political campaign, that would be unallowable under FAR. And lastly, another common disallowance is interest expense. So interest expense is unallowable for FAR. They do not care if you went out and financed your building. They are not going to reimburse you for that cost. All right. So many of these disallowances are very straightforward. You sometimes have to just think, what would the government want to reimburse me for, what they wouldn't, and what they won't? And now some of us may feel, well, that's just part of doing business. Well, they don't feel so. So again, interest expense, bad debt, donations, all not considered allowable. However, as I mentioned, there are some strange nuances related to other disallowances that could be misunderstood by many of the firms out there that we have experience dealing with, things that you may not even realize. If you have rent to a related party. Say you pay rent to a related party. There is a special calculation that you have to do under FAR to ensure that you're evaluating the ownership interest. So that is something that you may not have even realized. They want to make sure that you're paying a fair rent to any related parties and that you're not being reimbursing, say, an owner for more than what is fair value. So we have to look at all of those types of things under the FAR audit as well. So we talked about marketing and we talked about advertising. So a lot of the time people don't think, oh, well, I have a marketing director. Those salaries have to be disallowed as well under FAR. So you have to calculate any marketing salaries and that that you have for this marketing person. But it's not just them. All of you, I'm sure, spend time on marketing. So you have to track your time in your timesheets to code whether you're working on marketing or not. And remember, it's very important that direct sales type marketing, such as bid and proposal costs, that is tracked separately. So if you have a marketing personnel, marketing director, their time should be segmented between general marketing and bid and proposal time, direct sales type marketing. Because bid and proposal time, those types of costs are allowable. So it's very important that you're educating your employees on how to charge their time on their timesheet and that you're giving them avenues. If you do codes to your timesheet, that you have codes for marketing and you also have time coded for bid and proposal time. We talked about mileage logs. This is such an important hurdle that you get over in order to ensure that you're charging the proper amount of business use on your vehicles under your overhead rate. Travel and entertainment. There's a lot of rules surrounding travel and entertainment. You have to compare it to governmental rates that they allow for per diem. You're only allowed to fly economy. No business flights are allowed. So those are all things that you have to understand as common disallowances under FAR. Compensation, so salary analysis. This is such an important piece of your overhead rate is labor. Obviously, it's the largest piece, and it's a hot button point for many agencies such as the DOTs. They are looking at reasonableness of your compensation. So are you reasonably compensating your employees? So there are a lot of different analysis that can be performed, but typically you're going to focus on those top executive positions and looking at those highest compensation levels to make sure that they don't exceed what they consider reasonable levels. So what's reasonable? So under FAR, it indicates compensation for personal services is allowable subject to the general criteria. So compensation for personal services must be for work performed by the employee in the current year. So that's very important. We see very often in the following year, you may pay for prior year bonuses. You may have deferred a payroll and that's being paid out of in the subsequent year. This is very important when you're calculating your labor, that it's just representative of the current year payroll. No retroactive adjustments from the prior year's wages can be included in your compensation being reimbursed out of your overhead rate. Total compensation for individual employees or job classes must be reasonable for the work performed. However, specific restrictions on individual compensation elements apply. A lot of gray area within compensation. That's why it's really important that you talk to professionals such as ourselves about compensation and how you're treating it and whether or not this particular compensation might be allowable or unallowable. Is it reasonable? The compensation must also be based upon and conform to the terms and conditions of the contractor's established compensation plan or practice followed so consistently as to be implied in effect an agreement to make the payment. So this has to deal with a lot of your bonuses. So you're required to have a written compensation plan And when you distribute bonuses to your employees, that has to be under this compensation plan. We work with a lot of firms to develop these bonus plans to ensure that they're in compliance. We have seen DOTs come in time after time and disallow 100% of bonuses because you do not have a written compensation plan and you have not followed distribution of bonuses in accordance with this plan. So it's very important that in writing you have a compensation plan adopted and that you are following that when you are giving bonuses to employees. Bonuses are allowable, but they have to be to the extent of the compensation plan. So total compensation is evaluated when you're looking at reasonable compensation. That's going to include wages, salaries, bonuses, any deferred compensation. So some of you may be having deferred compensation plans. That has to represent current services performed in that year. So it's very difficult to analyze deferred compensation. You have to, some of the time, though, that deferred compensation is considered disallowed. So we have to look at that as well if you have compensation that's under a deferred compensation plan. 401k contributions, profit sharing contributions, all considered allowable as long as it's considered reasonable. And how do we determine that? So the AASHTO guide provides a step-by-step approach for performing compensation analysis. It's very complicated. So there's factors to consider such as your size, the industry, your geographic area. There's many national published surveys out there that you could use, WAG, PSMJ. However, for firms that are smaller, that gets very difficult. So you have this matrix, that's what was created by the AASHTO, that it's called the National Compensation Matrix. So you may hear your CPA mention the NCM. So they've created this survey that's nationwide of, based upon your gross revenue, what's considered a reasonable compensation for various titles within your firm. So this is what the survey looks like. So if I am a firm, each year this changes. So this is for 2023. They came out with a 2024 survey, which you would use for 2023 audits. And if my gross revenue was $5 million, this calculation would determine my maximum compensation for various levels of positions. So there's your CEOs, your CFOs, your vice presidents, engineers. So if I was the CEO and my gross revenue for my engineering firm was $5 million, the max compensation that would be reasonable under this NCM would be $376,500. So that would mean that I cannot be reimbursed. You can pay your employees however much you want. However, you're not going to be reimbursed through your overhead rate for these amounts. So you'll see I have total compensation of $395,000. I've already disallowed. My CEO performs marketing duties from time to time. So they were performed $18,000 worth of time on marketing. So we've already disallowed that. So when I compare those wages, there's another form of disallowance in excess of that 376 that, I'm sorry, the 366,714. So I would actually have to disallow the 9,786. Numbers are tough for me today. So you'll see that you have this guide that says, this is what my position is, and this is what the cap is that they're going to allow me to pay my employees. Now, some of our firms, you don't reach this cap. And again, this is salary, bonus, any deferred comp, any 401k contributions, all employer contributions included in here. Many of you may argue that this is just simply not a representation of the fair wage in the market. However, take that up with AASHTO. We've done our best to argue our side. Certainly there is other methods to go about compensation surveys. However, it's very complex and timely. So that's why most of the firms decide to use this NCM. And in 2013, they came up with this bipartisan budget act. I'm sure you've all heard of it, where it says we're actually going to cap contractors to a certain wage. So in 2024, this cap is $646,000. So if you're a very large engineering firm, you may find that your NCM may permit a $700,000 wage for your CEO. However, under this cap, we're going to have to cap you at 646. So it's important as you're determining wages that you're aware of these caps and taking a look at that so that you understand that you're not going to be reimbursed for those wages that you're paying out. Another item to track is and to understand is what is called facilities capital cost of money. You may have heard of it as the FCCM. So while interest expense must be subtracted from your overhead rate, that was an unallowable expense, firms are actually allowed to calculate and add on an additional amount for the FCCM, your facility capital cost of money. And what that's based upon is your average amount of fixed assets used in your firm's operations multiplied by a US security rate, at just interest rate. So this is how it's calculated. You would take your net book value, so that's whatever the value is of your assets less their depreciation, and you would average those out for 2 years, multiply that by an average treasury rate, and that's actually what you can add back into your overhead rate. So with this calculation, they were able to add 0.63% onto their overhead rate. And this is something a lot of CPA firms miss. They don't think to calculate this. And sometimes it's significant if you do have a significant amount of fixed assets that you're carrying on your books and records, and sometimes it's not. And again, this is for furniture and fixtures, computer equipment, vehicles, leasehold improvements, all types of items within your fixed assets. So one big component of overhead rates is ensuring your direct and indirect labor is recorded correctly. And FAR really focuses on that you as a firm are tracking your direct and indirect labor properly within a project costing system or a labor charging system. So if you do not have one of those implemented, that's something you need to think about, because that is a big component under a FAR audit, that you need to have a basis in order to track your direct and indirect labor. This is something that firms have a hurdle to get over their first couple years. So maybe you think you're going to have a FAR audit because you're going to be doing more and more business with state or federal agencies. Something you need to get your arms around is ensuring that your folks have the ability to charge their direct and indirect time properly, and that you're posting it correctly and consistently between those two accounts. Remember how I showed you the financial statement earlier of your direct labor up at top and your indirect labor down below in your overhead? That is very important that you're tracking that separately. It's critical in order to be able to determine your overhead rate. And timesheet preparation, review, and approval of those timesheets is also an internal control that we have to test as auditors of your procedures of your firm. So having all of that in place is very important if you feel as though you're going to have an overhead rate audit done in the future. So some of you, as you grow larger, you may have to have an office and a field overhead rate. And what that means is if you have field offices such as construction inspection, a project office, maybe you have some on-call engineers or contract employees. So they may be in a field office. So field overhead rates will obviously be lower than office rates, because not all of your costs at your home office would be absorbed by your field office. So this is just our example from earlier where we have all of our overhead costs, all of our FAR adjustments, and then we have to do this allocation. You'll see on the right-hand side, there's home offices and a field office. You'll see down below, your field office rate is much lower. It's 104 versus 136 for home office. So, and then you have your obviously an overall overhead rate of 131. So as you become a little bit more complex, you may only do field inspections for, say, a state DOT. Well, they're going to want to be reimbursed. They're going to want to reimburse you for a field office rate. They're not going to pay for your home office because they're not utilizing those services. So you have to work with your CPA firm on developing a method in order to allocate your home and field office. We've talked a lot about management's responsibilities, and I want to hit home with that a little bit more. By you attending this seminar today, that's really taking that next step at understanding what your responsibilities are under the ASHO guide, under FAR, of what responsibilities you have at identifying, segregating, and removing unallowable costs from your overhead rate. This requirement applies to all direct costs and indirect costs, and it's just very important that you, as management of an engineering firm, that you're understanding what that means. In establishing a sufficient internal control system. So this is very important if you're going to need an overhead rate audit, because we have to actually go in and review your internal controls. You must train your accounting staff to understand FAR, that they're noting and identifying and segregating and disallowing. Some firms, they disallow items right off the bat because they know it's unallowable and they record it in a disallowed expense account. And that's something that you may decide to do. Sometimes they may keep track offline and know that when it's time to give all of my CPA, all of the documentation, I've already identified a lot of the disallowed costs, and here they are. And you have that record for, you know, how much of the rent, how much of travel and entertainment should be disallowed. Things like, we didn't talk about this earlier, but alcohol. Alcohol is an unallowable expense. You have to be segregating out what, if you allow alcohol to be reimbursed by your employees, then you have to ensure that you are getting itemized receipts to identify if alcohol is included on those meals that you're reimbursing for, because that would be unallowable. This is so critical, and it's too often that we see firms that do not know if their FAR overhead rate has increased or decreased from prior year. And so they have really no understanding throughout the full year of where they stand in terms of what their overhead rate is. So when it comes time to truing that up at year end, you don't want to be that far off to what your expectation was all year long. So if a firm historically has an overhead rate of, say, 160%, and you've had a few FAR audits at this point, and on average, you're disallowing about 12% year over year of FAR disallowances, you know, those marketing costs, those donations that you're making, any excess compensation that you won't be reimbursed for, that's in excess of that national compensation matrix. So if you know that, and say all of a sudden your overhead rate is trending at 150, well, you know your true overhead rate, you know what to disallow from that. And so you know what your true overhead rate that you're going to be reimbursed for from the government is. So there's not a big surprise at year end. An AE firm really should exercise proper level of due diligence in selecting a CPA firm. So we've talked about this a lot. So what does that mean? Not every firm can come in and perform a FAR audit. It's a very complex statement that you have to understand. You have to understand FAR Part 31. You have to understand all of the AASHTO guide and the nuances of what is planning and performing and executing a FAR audit. AE firms, very, very specific in the sense of the way that you operate. You are not a manufacturer. You're not a car dealership. You're not a healthcare organization. AE firms are their own beast. Service organizations are their own beast. They're professional organizations. We understand that type of operation of a firm. So you really need to make sure that your firm understands what are all the nuances within a firm, because they are very unique in how you make your money. FAR audits must be performed under generally accepted government auditing standards. So many firms out there are not even permitted to perform government audit standards, perform an audit under government audit standards. So it's really important that you're asking the questions of your CPA firm before you hire them to ensure that they're even qualified to perform these audits. We do a lot of work with the New York State DOT here in New York, and we see firms that are submitting, engineering firms that are submitting overhead rate audits from CPAs, and they do not know what they're doing. And the DOT is coming through and performing an extensive analysis of what should have already been performed to disallow certain items under FAR. So they know if a firm is qualified or not qualified to perform these FAR audits, and they do have some sort of reliance on a CPA. A CPA, such as ourselves, may hold a little bit higher standing in states because they know we perform so many of these, whereas other firms may perform one or two. You can't specialize in something like that. So that's a little toot of my own horn here, that we do specialize in these types of audits, and you need to ensure that your firm is qualified, and that when you're submitting it to a state agency or a federal agency, that they're going to trust that CPA's work, because you do not want them picking it apart. That's something that the auditor is supposed to do. Under GAGAS, that governmental auditing standards, we are required to obtain certain continuing professional education under governmental auditing. We're supposed to have peer reviews. You know, those are all things that you should be asking your CPA firm before you hire them to ensure they're in compliance with those standards. Again, choosing a CPA firm, having working knowledge of the AE industry is so important. We understand the trends, the practices, risk factors. We know what's going on in AE industries throughout the country. We are able to base you off of your peers, how well you're performing, things you can improve on. Those are all things that are very important when choosing your CPA firm. You know, we talked at length about having extensive experience with performing FAR audits. Obviously, you see, this is very complex. Otherwise, you wouldn't have joined me today. Having experience performing FAR audits is crucial. So I talked about peer review reports. As an engineering firm hiring a CPA firm, this is something that you should be requesting of your CPA. We are audited by a peer review firm that reviews a sample of our jobs and our audits and our reviews, that we are holding up to the standards that we're supposed to. And this letter is basically showing you, yes, we are a certified peer review company, CPA firm, that, you know, we have no issues, and that you have a little bit more confidence in our work because of the work that has been done by the National Peer Review Committee. FAR audits. So we've talked about this. I won't go through this too much more. Again, there's generally accepted auditing standards we have to follow. So when you go to hire a CPA firm, FAR audits are extensive. We have significant amount of standards we have to apply under these FAR audits. It's not as simple as saying, you go and identify what your disallowances are, we'll put it in a form and we'll issue it and put it on our letterhead. It doesn't work like that. There are so many standards that we have to comply to in order to issue what we call an opinion. A FAR audit can take anywhere between 100 and 150 hours, depending on the size of your firm. That's small to mid-sized firms, I would say. There are a lot of different complexities that may have with larger firms that we have to consider. Some may be very straightforward. You may have very little overhead expenses, and those would trend maybe more down towards the 100 hours. But again, if you're doing your job as management, hopefully you can help minimize the amount of hours that has to be spent. But when you go and you ask for a FAR audit of a CPA firm, they are costly, unfortunately, but there is a set standard that we have to perform in order to issue that audit opinion. And it's unfortunate, but it's a requirement. Requirements of a FAR audit, we do have to execute an engagement letter with you. We would have to understand the environment. So we have to get to know your business, understand a lot of different nuances that you wouldn't think that we would need to understand, but we do under our standards. We have to test internal controls. We look at risk. We look at fraud risk. We have a lot of interviews of management. That's all covered under the FAR audit. We do substantive testing. So we test your overhead costs. So we're not only just asking you what the disallowances are, we actually do a significant amount of testing of your travel costs, of your utility costs, things like that. We test payroll processing. We test labor between direct and indirect to ensure that's being charged right and broken down correctly in your software. We test compensation for reasonableness. Of course we do. So there's so much that we have to do as part of this audit. This is actually, when you get an audit, this is the biggest piece. This is what the state agencies and federal agencies are looking for. They're looking for this opinion. They're looking for what we call a clean opinion. So this is that there were no issues and that the financial statements for the indirect expenses, direct labor, and overhead were in fact material in all respects. So internal controls, why is that important? Again, ensuring that you are categorizing direct expenses and indirect expenses properly, that you have control over your cash disbursements. We look at all of those items as part of the FAR. We have to also issue this sample or this internal control and compliance report. That's really important. This is something that the agencies are looking for. Were there any issues in regards to internal controls? So this is in fact a clean report that issues no deficiencies. Were there any material weaknesses within your controls? So again, if you feel as though you're going to be needing a FAR audit down the road, you're going to need to make sure that your internal control processes are in place so that we're not having to write you up with a deficiency. Because unfortunately, payroll, if you're not recording payroll properly into your direct and indirect categories, you do not have a sufficient payroll timesheet process, that's a deficiency that we have to report. So I'm just looking to see if we have any questions. No questions at the moment. If you have any, you can feel free to type those in, or we're going to provide this PowerPoint at the end. We'll email this all out, so it'll have all my contact information. It'll have all those dates for you that we have for the seminar series, for the ownership transition and valuation guide. So hopefully, in summation, you've learned a few things, probably that you need to call me tomorrow, and that's fine. We work with so many firms at all different stages, some that are 2 years out from needing a FAR audit to some that are in crisis and needing a FAR audit as of yesterday. So wherever you're at in the stage, we can help you. It is a complex requirement. We're going to teach you, we're going to help you understand what's allowable, what's unallowable. We're going to help make sure that you're in compliant, that you're giving the best, the most efficient and most maximized overhead rate possible that you're going to be reimbursed for. So we're going to work with you on that. So if you do have a FAR audit that's required, it is just really important that you do read those guides and that, if you want some more training, we've gone into firms and given training to their employees because one hurdle that you really have to get over is great. You're the CFO, you're the controller, you understand FAR, but it's really important for those people that are going out and charging the time that they really understand how to properly categorize their time, that they're recording their time when they're working on a job and understanding that even though that hour may not be billable on the job, it's still considered a direct cost to the job. So it's very important that you record that. I really appreciate your time. We went through this very quickly, and it's something that has taken us many years to really fully develop an understanding of FAR and how it relates to your firms. So we look forward to hearing from you, any questions you may have, and again, appreciate your time today.